To our breakout Stacking Capital for Renewable Energy in Wisconsin. I'm Jason MacDuff. I'm the president of Greenpenny. If you weren't in the group this morning, we're a bank, and I'll talk a little bit more about what we do in a minute. I want to thank our sponsor, which is Savion. They were supposed to be here, but they had some project conflicts that made it so that they couldn't join us. Otherwise, they would be talking about what they do. But we want to make sure we acknowledge their sponsorship of our session. So thank you to Savion. We're going to have a moderated session here. So I've got some prepared questions for our panelists. I'm going to let them introduce themselves here in a minute. So while we're having that conversation, please be thinking about questions that you all have as well. If you're in the room here, or if you're virtually joining us this morning, we would encourage everybody to ask their questions through the app. And if, to the extent possible, we'd like that to happen. If for whatever reason you'd prefer to just raise your hand and ask it here, that's fine too. Either way, we're going to repeat the question into the mic so everybody can hear it and we can be inclusive that way. You know, our objective here is just to talk about different ways in which projects, solar energy, renewable energy projects can get funded. And there's lots of different mechanisms for doing that in the capital stack. And so each of us have a different perspective and experience and a role to play in making that happen. And so the objective of this session is to share information with you all on ways that we can do that. If you all have ideas and experiences too, we welcome to hear those, of course, as well. So with that, I'm going to allow our speakers to introduce themselves. Timothy, why don't we start with you? And maybe talk a little bit about your organization as well.
Sure, thank you. And thank you all for being here today. I'm Timothy DenHerder-Thomas. I'm General Manager of Cooperative Energy Futures. We're a clean energy cooperative based in Minneapolis, Minnesota, and working with a number of communities across the state. As an energy co-op, we're a clean energy co-op, so we're not a rural electric. We are really focused on enabling our members to participate in clean energy. Really removing the barriers for residents in our community to access clean energy without having to invest money up front or, have a high credit score, whether or not you can put solar on your own home. So Minnesota's community solar model has been really essential to that. We are also now starting to collaborate with groups in a number of other states, including some projects in Wisconsin that are trying to use a similar cooperative model to build wealth and create access to the solar industry. I've spent a lot of my time on project financing, so we'll talk in a little bit more about tax equity and project debt and all of the financing opportunities and challenges that come along with it.
Very good. Thanks, Timothy. Alicia, can you go next? We'll just go down the line.
Well, I'm not.
You can go ahead and introduce yourself.
I'm Alicia Lineberger from Ethos Green Power in Viroqua, and I'm actually just monitoring the question.
Alicia's on the board of Renew Wisconsin, and she's
no,
helping to support our breakout. So thank you, Alicia, for doing that. Kurt?
Hi, I'm Kurt Reinhold, and similar to what Timothy was saying about his work in Minnesota, I do a similar thing in Wisconsin. I helped start, co-founded Legacy Solar Wisconsin Cooperative. We have about 340, somewhere in there that we get new members all the time, but we've been in existence since 2014. And we do also a lot of project development work, mainly, business planning, pro forma financials, bringing in tax sponsors to help support community solar projects. We also do a little bit of consulting on the residential side, but mainly our bailiwick is working with community institutions like churches, libraries, schools, civic organizations that want to put solar on their roof or solar as a ground mount. And we help to leverage some tax benefits, toward that end and bring the overall cost down. And happy to be working also a little bit with Greenpenny. So we are one of many layers in that capital stack, and we'd like to talk more about that later.
Very good. Bryan?
I'm BJ Dworak. I'm an attorney at Foley and Lardner in Milwaukee. We're a full service law firm. We are founded and are headquartered here in Wisconsin, but we have, I think, about 1,300 lawyers across 24 offices in the US, Asia, Europe, and in Mexico. My practice is exclusively in renewable energy. I sort of split pretty evenly between doing sort of traditional project financing in the debt space, tax equity, both buying and selling projects and sort of solar companies, and then some project development work as well. We have a sort of a long-standing energy team, last 20 years focused mostly in renewables. And we represent kind of all the participants in the deals: tax equity investors, lenders, developers, sponsors, buyers and sellers of projects. We recently picked energy as sort of one of 4 kind of key sectors of the economy that we're focusing on. So really kind of our one of our prime focuses going forward.
Very good. Yes, and the commercial space, we often say that those deals are creatures of contract, and so you might be wondering, why would you have an attorney in a session about capital stack? Well, the reason is because they're essential to those projects getting done. You all may know that. I'll say a quick few things about Greenpenny. We are a financer of renewables, mostly solar. If you heard us talk about Greenpenny a little bit this morning, so I won't belabor it, but we do residential financing, we do commercial financing, ag, nonprofits, so municipalities, school districts, universities, hospitals. Ag is a big focus of ours, businesses small and large. So I'll be talking about the role of banking, and increasingly, hopefully more banks will get into the space, but so far there haven't been a lot of traditional banks yet coming into it. So we'll talk a little bit more about why that is and hopefully how that might change. All right, so first question, Timothy, I'll start with you. Tell us about your experience with finding tax equity investors and financing for your community solar garden projects. What's worked well and what are some of the challenges you kind of alluded to that you're still experiencing?
Yeah, so I'll just start off. I'm assuming many folks here today are familiar with tax equity, but just really in basic, tax equity is equity investments from large investors who want to invest primarily to use the federal tax credits and depreciation benefits. There's a variety of things that go along with that in terms of requirements. The first is ownership, and as a cooperative, a community-based entity, that presents an inherent problem that we've had to get very creative to get around, because as a community, we want to ensure ownership for our members. In order to deliver tax benefits to a third party, they need to have ownership. There's a variety of different models that have allowed kind of the balancing of those interests. We're focused on one that many of you may be familiar with called a partnership flip, in which we as the cooperative become the long-term managing member. We have a minority ownership stake for the first 5 or 6 years, and then ownership flips to us having a majority ownership stake, and we can buy the tax equity investor out. The tax equity investor is getting some cash, but the majority of what they're getting is those the investment tax credit and the depreciation benefits from solar. And then we layer on project debt and bring some equity into the table as a co-op ourselves. The industry for tax equity is very, it's narrow and specialized. The vast majority of tax equity investments are made by a relatively small number of private investment firms, banks. There's some high net worth individuals who have certain types of income who qualify, but it's a relatively narrow sector in terms of who will invest. And it's pretty common for investors to be interested in projects at a certain scale. So you need to get up to a certain overall portfolio size in order for most investors to be interested. There's also sometimes complications when you're doing community solar in terms of concerns about, off-taker risk of how reliable is your base of subscribers, especially if they're large numbers of residents and low-income residents in particular. So there's all sorts of vetting and due diligence that have to be done about that. We initially started trying to do a pilot project, which was a roughly 200 kilowatt rooftop community solar garden. We found that nearly impossible. We did ultimately find kind of a unique tax equity investor relationship where a high net worth individual in the Twin Cities stepped in and played that role. But we didn't find it very scalable. And so what we did for our second round of projects is we bundled 7 projects into a portfolio, total capital costs of about 16 million, so about 4 million, 4.5 million in tax equity. And that was really where we got to a scale where we were, even still at the lower end, but of interest to tax equity partners. And it's still a difficult process. And I would say tax equity is still by far the most difficult and the most legally complicating piece of the whole financing picture. But that's become sort of a template for what we're now doing with our second portfolio of projects, and more or less what we expect to continue doing in the future, unless, of course, federal policy changes and makes those tax credits refundable. So I will pause there.
Very good. Kurt, tell us a little bit more about the accomplishments of Legacy Solar Cooperative and where you see opportunities for additional progress in the future that might benefit folks listening today.
Okay, well, thanks, Timothy, for that description about tax equity. And that alleviates me from having to explain a little bit about what that is. But yes, we do a lot of work by way of explaining some of the accomplishments. We've worked with a lot of different tax equity providers, but they're not always institutional investors. In fact, sometimes they may just be ordinary individuals, but they could be a small part of the overall impact that the co-op has, but they could be a large role in one individual project. So we do projects small to large. 2.83 kilowatts. This is the smallest project that we actually did tax equity financing for. Maybe that's a world record. I don't know. But, as large as, upwards of a megawatt. But, for projects that we've finished, we've done a school project most recently. You may have seen some of the slides earlier from Michael Vickerman. We worked on the school district of Rice Lake project and did 3, individual schools. The total amount was about $1.2 million. And so we worked with a local company that, has goodwill already baked into their relationship with the community, and stepped forward into that role of tax equity sponsor. And we did a moving over from finance to legalese, we did a prepaid service contract for that, so that the school district could put their ownership share or future ownership share into it at the beginning, and blend in some tax equity, as a way to leverage those benefits. But there's a 5-year recapture period that the IRS places, and you need to respect that, and any kind of change in ownership for the assets that are covered by a tax or a tax credit, that change of ownership, especially when it's a not-for-profit, needs to be at fair market value. So you have to follow all those rules. So yeah, there are finance considerations, and that's the topic of this talk. But also there are legal considerations dealing with contracts and dealing with securities law, utility law, and IRS tax law. So those are kind of the 3 areas that we have to follow those regulatory constraints. But once you figure it out, you can more or less replicate. But there's still a lot of time with each project that you have to spend with the stakeholders, because even though I live and breathe this stuff every day and I understand it, it's hard to get some of these concepts and some of these complicated relationships and mechanisms to get the job done, to get that story relayed to the individuals who are on the school board, or the individuals who are part of the church governing committees and the building and grounds committees and all of that. So there's a lot of education in our work, and that's probably, education and problem solving, and then communication skills and being able to just work with the multiple parties, including the utility and the, the different legal counsels that come to the table to try to compromise and get the job done. So, but anyways, I think maybe that talks a little bit about accomplishments. I probably went a little wayward from the question, but opportunities that I see are really just, continuing to do what the co-op has been doing, which is we don't own any projects. Actually, we do own a project now, but we don't own a majority of the projects. We just act as consultants, and we do provide some tax equity from our membership. But you don't necessarily have to be a member of the co-op to be a tax sponsor either. So, we're pretty much a flex fuel vehicle to get, community solar projects accomplished, and we just deal with one at a time and figure out the best way to get the job done.
So, very good, Kurt. Okay. Bryan, as we mentioned, quality contractual agreements are essential to ensuring capital investments and financing are available for solar projects. What advice would you have for the audience to ensure all involved are protected and the economics of a deal are maintained?
Yeah, I think how I'm thinking about this is it's never too early to start thinking about those things. I know a lot of folks are eager to, get started on a project, get contracts signed, whether it's a lease for a piece of property in order to build it, whether it's an agreement with somebody to purchase the power from a project. Folks are really eager to get started. At that stage, though, folks don't want to spend a lot of money either. And that, sometimes comes down to not spending a lot of money on folks like me and my colleagues. But I do think good project development starts at the beginning. If you cut the corners at the beginning of development of a project, especially I think as the industry continues to mature here in Wisconsin, you're just going to have to go back and fix those later. And I think that's where a lot of kind of frustration comes into, as Timothy was saying, sort of the legal due diligence process is when issues are getting flagged and it's a project somebody's really passionate about, really proud of, and they've been working on for years. And then, a lawyer comes along and it's like, well, you've got to do X, Y, and Z before my, client is going to give you a tax equity investment in the project. It's frankly generally more expensive to fix it later than it was to do it right from the beginning. And I think that's really key when it comes to kind of the project documents. From the economic perspective, I think that's part of it is it increases your transaction costs later on, right? Sometimes a little money up front can save a lot of money in the long run. The other part on the economics is just to be thinking, and this is probably organizations like Kurt's and others can help with this, is it's important to be thinking about the full sort of how are you going to finance this project and how are all the numbers going to pencil out up front. If the amount that you're getting paid for the power is nowhere close to what it's going to cost to buy modules, solar panels that are continually getting more and more expensive and harder to get, well, your project's never, it's not going to have a very bright future. So I really think thinking about all of those things early and being thoughtful about it is kind of the key for long-term success. And I think if you do that, there's going to be a variety of financing options available for you. Your financing parties are going to be comfortable with the project if it looks like what they're used to investing in or lending against. And, that's really best for everybody. I think most people come to the table because they want to put money into these projects. They're not looking for a reason to get out of it. But sometimes, institutions can't take certain risks. So I think just, being upfront about those and deliberate is really important.
Sure. All right, be thinking about questions you want to ask, and ask one more question for everybody to jump in, and then we're going to open it up. We want most of the questions to come from you guys, not from me. I'm just going to ask this of everybody, and feel free to jump in, anybody who would like to. As an industry like any other, we're always looking for ways to improve. When it comes to access to cost-effective capital and financing for solar projects, what are some areas that are not working well enough today and that need some attention from your perspective?
Gosh, I had an answer, but now I can't remember what it was. Should I jump in or is okay? So just a quick preface for my answer. Co-ops in the state of Wisconsin, like ours, can raise money from our membership. And so we do have a unique set of opportunities, constraints, but also mainly opportunities to be able to sell co-op bonds to our members. So it ends up being more of a private offering rather than a public offering. So, we can kind of set the cost of our capital for projects that we're investing in by the, somewhat mission-driven population of members of the co-op who are owners of the co-op, but more or less, can give us a break on on the cost of money. So we have that unique opportunity in the state of Wisconsin. We do have to abide by both state and federal securities rules regarding that. And so we can only offer co-op bonds to members of the co-op who are owners, but also who reside within the state of Wisconsin, bona fide residents of the state of Wisconsin. That allows us to be exempt from some of the more onerous securities requirements on the federal level, but still we have to, abide by the anti-fraud provisions overall, and just, do good business and make sure that we adequately spell out some of the risks involved with investing and being, straightforward with all those disclosures. So there's a whole, that's why we have lawyers to make sure that we are doing things appropriately and not unintentionally misleading people into, what the promises are for investing in the solar projects through the co-op. But again, that's not something that is not working, which is the valence of Jason's question is like, well, what is not working? Well, for us, it is working because we do have that special provision within the state and federal regulatory. We figured out a way to raise money from our members. Now, that doesn't mean that there aren't constraints that affect us outside of our co-op. There are. I mean, Jason and I, we compare notes on what the trends are in the industry. And as far as if we have a member who's a residential customer who wants to put solar on his or her home, they may not be able to get a loan for the period of time that they're looking for from their usual community bank that they might go to. So they might need to go to a bank like Greenpenny in order to get a 15 or 20-year loan in some cases, depending on your credit score. But that allows you to amortize those costs over time, and you can and there's no, as far as I know, there's no penalty for prepaying. So in some cases, having a loan product that is flexible enough to provide the amount of capital that you need to get the job done is really important. But as long as your energy savings from your electric bills are able to pay down the loan and actually be close to break even, if not positive cash flow, that's where I think you kind of are able to make it work for a greater population of people.
Yeah, I mean, what Kirk's alluding to is the reality that we faced towards the end of last year and studying and talking with our borrowers and talking with installers, as for the first time, and Michael Vickerman mentioned this morning, for the first time in a long time, the cost of systems are starting to rise. And we're seeing our average loan sizes come up. And when you're trying to, your value proposition, what you're trying to make work for borrowers is that they can trade their utility payment for a financing payment if they need to finance the system, which a lot of folks do. A lot of folks don't have the funds to be able to just put a system up with cash. They can trade a utility payment for a financing payment. And then what we'd like to see happen is that they pay off that loan as soon as possible, because they can enjoy many, many years of a pretty de minimis utility expense, maybe just a hookup fee to the utility or something like that. And what we found is that and also rates are rising. So we're in this, we have this 1-2 punch that started to happen. And so what we did is we elongated our terms so that we could make that more possible, that trading of a utility payment for a financing payment. So we'll go up to 20 years. And that's scary for a lot of banks because you're talking about delivering loans that are fixed rates for 20 years. And if they in fact stay on the books for a long time, you're taking quite a bit of interest rate risk with that. But we believe that the actual experience will not be that those loans will stay on the books for 20 years. Our expectation is that the average American lives in their home for 7 years. People move. Our experience in Decorah over the last 20 years is that the average life of the loan is typically about 7 or 8. And so we're hoping that that stays that way, and that all we're doing is elongating our terms such that we can make it more tenable on a monthly budget for folks. But we're talking about constraints here. You know, as rates are rising and as the cost of systems are coming up, it's interesting to see how that's having an effect on the financing options for folks. And we've certainly had to deal with that as greenpenny. So thank you for bringing that up, Kurt. That was a good constraint. Any other thoughts?
I think this question kind of lends itself to sort of a policy answer, right? Of what sort of, legislation or policy changes can happen in Wisconsin. I won't get into sort of, my personal thoughts on what the right legislation is, and leave that to the policymakers and lobbyists and others who are here today. And I know speaking, but I think one of the folks in the introductory session, not sure if it was Lieutenant Governor Barnes or somebody else, said ultimately a solution does need to start in the legislature, and I think that's right, to really kind of grow solar to the next step in Wisconsin. But I think what we can't lose sight of in that process is, a lot of our neighboring states and states in the Northeast have, passed great incentive programs for the development of solar in Wisconsin, and those might work, but we can't leave. All stakeholders have to be involved. I know a lot of the focus there is around utilities, and you need to make sure the utilities are engaged and ready to actually be able to hook systems up, right? Because it's great to incentivize, construction of something, but if you can't plug it in and it can't actually exist on the grid, it doesn't really do any of us much good. And I think, we see that in the Northeast, in Massachusetts and Maine, where they just have these clogged interconnection queues to get projects plugged in. The state has a lot of those states have a lot of incentives to build solar, but without sort of, sitting down with all of the stakeholders, utilities, developers, the financing parties, and the legislators, right, in local communities, unless all of them unless it's going to be a workable solution for everyone, it ultimately, isn't. I don't think it's really a workable solution for financing projects here. So I think it's really important to keep all of them engaged.
Yeah, go ahead.
I just wanted to kind of echo a couple of things. First of all, just what you were just saying about policy is the starting point. An effective compensation and development structure is the foundation of financing. And then, also to the point just about co-op, co-op financing, Kurt, that you're mentioning, we've used a very similar structure with cooperative preferred stock, and it's been really the centerpiece of raising equity. We have very similar laws in Minnesota for co-ops. So that's been a really powerful tool. But to speak to a couple of different challenges, I again wanted to just highlight that I think traditionally in solar financing, financiers have looked at the financial viability of specific customers. And, in certain cases that makes sense. If you're selling energy to a utility, you look at the credit and financial standing of the utility. If you're selling energy to, an individual household, or you're financing an individual household, yeah, maybe it makes sense to look at the financial standing of that individual household. What we've seen as one challenge in the community solar sector that I think is starting to evolve, but it's still a big issue, is as community solar has started to be developed here in Minnesota and all around the country, a lot of financing entities, both lenders and tax equity partners, are trying to look at the financing criteria for community solar as if it is still vetting the financial standing of specific individuals, which has become an almost impossible process when, for example, we're building a project with 180 different households. We are very early on kind of took a position as a co-op, we're not interested in this financing. If you want to evaluate the financial standing of every single subscriber we might possibly have in this project. Because in community solar, you can change around who's in the project, and it's administratively a nightmare to try and do all of that vetting. It excludes a lot of people, and it's not particularly relevant to who is actually able to pay for their energy. So we've started to make the case, and we've seen more and more investors looking at community solar in particular, lenders and investors looking at community solar from a perspective of how stable is the risk profile of having off-takers, as opposed to, what is the specific economic situation of specific individual off-takers. And I think that's a really important innovation in the financing sector that, again, I think is already underway, but it needs to continue. And then I will just also mention that I think really at the heart of the challenge of financing solar is the current structural problems with how federal tax credits are set up. They are set up to be accessible to specific types of owners in specific types of situations. And whenever you have a situation like community ownership of a shared renewable energy asset, it forces you to go through a massive amount of legal and financial gymnastics to fit that into the structure. That raises costs, it makes it harder, it takes more time. I think there's some structural and equity issues in terms of how federal tax credits are structured that really need to move in order to make solar a lot easier
and accessible to more people.
And
That's good.
I was going to say, Jason, to Timothy, to your point on sort of the how investors and lenders are underwriting community solar subscribers, I do think there's a trend even among sort of major financial institutions towards focusing more, especially if there's a mix of residential and commercial and industrial subscribers to projects, to focusing less on the individual residents. Even last 5 years, certainly at lowering a minimum sort of FICO scores of residential customers, or sometimes even not looking to those in all cases. And I do think that sort of trend from a financing of those individuals perspective is it's getting friendlier towards the developers, because I think as community solar, is sort of one subset of this broader solar conversation has matured. I think that folks have sort of viewed customer churn is okay. And actually the risk of maybe it's easier for a residential homeowner to terminate their subscription agreement from a community solar project than it is for, somebody who has, a big box store that has solar on its roof. I guess in other states that would be, but they've realized it's really easy to replace that customer. And I think even big banks and their credit committees have started to get a lot more comfortable with that risk than they were a few years ago.
Experience
Yep.
data sets too that have helped with that.
Yeah.
I'm hearing that we've got some questions. I want to make sure we get to them. Alicia, do we?
Yeah, we have a lot of questions.
Oh, good. That's
And
great.
they span across. I'm gonna try to group some together.
Okay.
There's definitely a question about munis and co-ops being owners. Can municipal or co-ops be the owners of panels on commercial buildings, or must the building owner be part of the co-op? And kind of in a similar, can a municipality sell tax credits to high net worth individuals through a partnership flip? And so it sounds like getting at a specific type of model. Yeah.
On the co-op front, I would certainly defer to Kurt or Timothy. Obviously,
I think they're talking about municipal and co-op utilities,
Electric co-ops.
electric co-ops and municipal utilities.
I don't know.
can they? I mean, I think it depends on sort of the specific facts of it. Wisconsin obviously is complicated in terms of who can own projects. I'm not exactly sure on that one.
And this
with that
kind of
question.
goes in with that answer. Are third parties who finance equipment producing renewable energy subject to any public utility regulations by the PSC?
That's
Oh,
I
we've
think
never had any issue with
that's
that. Never.
the big question, or that's the big debate in Wisconsin, right? I mean, as of now, I mean,
Today?
uncertain, right? But yes, they certainly can be in Wisconsin.
So I'll jump in, and Timothy, you probably have a different take from Minnesota, but so our cooperative isn't I think the same as what an electric cooperative is. So, our co-op, like I mentioned earlier, we don't necessarily buy and own and control solar projects. We kind of steer the stakeholders in a direction and then help support them technically and financially. But the ownership is typically, whether it's a landowner or whether it's a homeowner or whether it's a civic organization or even a city hall or a library. The ownership it can be complicated, especially when you're trying to use tax equity financing with a not-for-profit organization. So there are ways to, there are multiple ways to solve some of those ownership or partnership flip arrangements. But in terms of the electric cooperatives or the munis, I think sometimes it boils down to, what is their ability as a cooperative to pass the tax benefits from the federal government or at the federal level to the individual owners of the co-op, because that ownership could be complicated, more complicated than just a few individuals. It's probably a whole community, and there are boards of directors and there's different ownership shares. And so it can be a nightmare sometimes, I think, for tax benefits to be filtered down to the individual investors or owners. And that's why we prefer to, just raise money from our membership. And then as a co-op, we make individual secured loans or we extend debt to project stakeholders. And then that's how we get paid back. It's through loan payments from those tax sponsors. So we just add another layer, another, platform in the capital stack debt, but it's easier than communicating ownership benefits through, a complicated tax equity structure.
I'll just add to that, and again, I can't speak to the Wisconsin PSC issues, but just that it's typical in structures where you're trying to have a third party monetizing the tax credit, since, for example, a muni or a co-op usually can't, a rural electric co-op usually can't use them themselves. Kind of like Kurt was saying, you usually can't have a nonprofit entity directly in that structure. You can kind of have indirect ways that ownership will transfer to that non-taxable entity after a period of time, but it gets complicated how to write the contracts in a way that those rights are really protected while still staying compliant with the IRS rules.
More questions?
Yeah, that's such a fun subject. It's great to experience. But one really basic question. If you guys could just give some examples of tax equity investors, banks, insurance companies, which business types are possible? Like, what are the parameters around what a, besides a high net worth individual, or maybe including that?
Yeah, I'm happy to take this. I mean, a lot of the large national banks are certainly tax equity investors. You do see a number of large or of regional financial institutions are tax equity investors. Another big one you see, they often aren't leading deals, but are participating in deals led by some of the bigger banks or life insurance companies. They typically have or might have income that gets offset. You do see some private companies too. The rules are a lot more lax for corporations taking the investment tax credit than they are for individuals. For individuals, it can really only offset passive income. And that's why the rules get so complicated, and it's really, really hard to do tax equity deals with just individuals. But you see a lot of just random, frankly, household name private companies in the tax equity market who are participating in deals led by, more traditional financial institutions. There's a number of kind of they're not brokers per se, but kind of outfits that will lead tax equity deals, place tax equity deals, but that don't actually take any of the tax credits themselves, but, you know, sort of represent and work on behalf of, you know, insurance companies, private companies, et cetera.
Good.
Are there-
Yes, I'll jump in just quickly and just say that, you know, tax equity, like Bryan was saying, you know, can come in different forms, but the company, you know, a C corporation, I'm not an attorney and I'm not a CPA, so I'm just going to say that in general, a C corporation is able, you know, if they have taxation at the entity level, meaning, you know, they have to pay taxes on the net revenue that they after expenses, that they can sometimes absorb you know, a fair amount of that tax credit and depreciation, depending on the size of the project. Now, if the size of the project is for a community solar project that is bigger than what their tax appetite is, well, then that's where it gets more complicated. You may have more individuals involved, but at the corporate level, it can balance out and be a nice ledger exercise that you know cleaves off 25 to 45% of the cost of the project in the first couple of years if it's set up properly.
Good, thanks, guys. More questions, Alicia? Okay, yeah.
The goal is to keep the dollars local and benefit from the economic activity from keeping the dollars local. All these people, national banks, life insurance, private companies, a lot of those send the benefits outside the community. What is the best way that you, in your opinion, that you can keep the money local and finance the project and include the idea that you have donors who take a charitable contribution, that's not really been talked about, in lieu of tax equity? Give me some ideas.
Okay, I'm gonna just repeat that, ma'am.
Yeah.
What's the best way to keep those investors and the return on them local as possible, not these national deals, but local? And also, have you considered incorporating donors who can use charitable contributions as part of the capital stack?
We'll let Timothy take that on first, because I kind of hogged the second half of the last question.
Oh, no worries. I think that's a really important question. I think from our take, especially for larger community development projects, it is very hard for communities to directly receive the tax benefits. So what we have seen as the best way to ensure that the vast majority of the economic benefits flow through the community is to structure a tax equity deal that is almost entirely tax benefits to a third party and very little of the financial returns of a project to that investor. There are different parameters about how to make that work, but we can structure it, and we have structured it where, you know, that's maybe 5% of the project cash. And the vast majority of the project cash is going to either cover operating costs, you know, pay low interest debt from a local financing institution, and create direct dividends and returns to participating members, which, you know, for us is roughly half of the total financial revenue stream of the entire project, even after we take away financing costs and operating costs and everything else. So there are ways to structure those deals so that without requiring a massive amount of upfront cash from a community, which, you know, to the extent that the community can put it in is great. And again, we've sourced, you know, 2.7 million from our membership. But there's limits to that, right? When you're trying to build, you know, tens of millions of dollars worth of clean energy infrastructure, there are still ways to structure where the vast majority of the financial benefits come back to the community. I'll kind of leave the charitable donation question for others. It, again, if you're trying to use the tax credits, makes it even more complicated to get a charitable model in there. I am familiar with some people who are trying to work that out, but it's very, very tough legally.
Well, we are just over time. And so I'm going to suggest that, I know we've got more questions we weren't able to answer. We're still here, all of us at the conference. And if you're attending virtually and you want to reach out to us through the app and any one of us individually, please, we'd encourage you to do that so you get your questions answered. Our contact information is there too. So even after the conference, if you want to follow up that way, that would be fine as well. Thanks for the engagement, everybody. And I'd like to thank our panelists. Let's have everybody give a round of applause, please. Timothy for joining from Minneapolis. And thanks, everybody. We'll see you this afternoon at the rest of the conference.
I'd like to